All right, so chapter 15. Uh, Technically, the most important chapter of the whole class, I would say, because this is what people get paid to do in investment management, okay? Financial statement analysis, where you take your knowledge of accounting, which means that you can understand a financial statement because that financial statement is composed using the rules of accounting that we've been learning, using your knowledge of business, of whatever industry this company is in that you're analyzing, combining all that together to understand what's happening in the business. Okay. And making a decision based on that. Usually it's an investment decision, some management decision, but it's to inform decision making. Okay. And so you need to know a lot to be able to do this well. You need to, of course, know the rules of accounting really well. You also need to understand business, okay? Because the financial statements are not the totality of the business, right? It's like there's a lot of things that are happening in the world that are not captured in the company's financial statements. So it's an art too. Okay, there's a technical factor of knowing accounting of in understanding the financial statements, but you there's a lot of judgment, there's a lot of business knowledge, general business knowledge that you have to do this really well. Okay, not many people do it really well. That's why it's hard. It's really hard to beat an index uh, stock investment fund. Okay, even though there's people making a lot, many people, thousands of people employed in trying to do this well, it's very difficult to beat just the general broad consensus view uh, more often than not. Okay. Um, but we're going to learn, because it's like even if you have a small business or whatever, there's some level of financial statement analysis that you should be comfortable with. Okay. So we'll explain how financial statements are used to analyze a business. Um, Horizontal and vertical analysis are ways that you can basically take the raw data from the financial statements and convert it into a more interpretable form. Okay, so we'll talk about these two, and then the ratios. Okay, so we've been covering a lot of these. We've done quite a few. We're gonna now re-summarize them. They're kind of you can categorize them into certain buckets of like what information or what theme they are. So we'll just recap these ratios and organize them into themes. And you can then you'll be asked, of course, in your homework and stuff to calculate the ratios and kind of give some interpretation. So really calculating the ratios, just the technical ability to do that is not so hard. It's interpreting them, contextualizing them. That's the hard part. And that takes, a lifetime of practice and understanding business and experience. Okay. But, at the beginning, it's just calculating the ratios and having a basic understanding of what they are. Uh, for this class, I think that's pretty good. Okay. So we'll just kind of start with that. Okay. Um, so financial statement analysis, why are we doing this? Um, well, it's to help us form some analysis for decision making. Okay, so uh, what are the types of analysis we can do? The first is we can compare one company to itself over time. Okay, so if you had multiple years of financial statements, you could see how the company is doing over time, what is changing. Okay, um, and you saw a lot of the financial statements from companies that we've been looking at, they usually present at least 2 years, okay? Sometimes more, sometimes 3 or 4. But that is to facilitate this exercise of comparing the company to itself over time. You can also use financial statements to compare one company with a competitor. Okay, so if you have two different companies, you can perform an analysis to see how the company you care about stacks up against a particular competitor. Okay, so maybe if you're looking at retail companies, You look at Walmart versus Target, okay? Or TJ Maxx versus Ross, right? These are examples of two companies that are like distinct industry leaders, you know? These are like large big box retailers like Target and Walmart are the two biggest, right? Uh, Discount clothing retailers, TJ Maxx and Ross, you know? So sometimes there's a natural single competitor that is worth looking at. Sometimes it's worth it to compare your company against the industry average, right? So if you're looking at like a steel maker, okay, maybe there's not just one competitor. You want to see how does your steel company, steel manufacturer compare to the other industry, like the industry as a whole, right? How much are their margins competitive, etc. Okay, so uh, again, this is using this term benchmark, okay? So you compare your company with some industry benchmark, and this is a very common practice because you want to make sure your company is not below average, right? You want to be at least average on the things that are important. And if you're below average, this is a cause of concern. Um, you're not maximizing the potential of the company, at least compared to your peers. Okay. This is, people are talking about consulting companies going out of business because of AI. One of their key functions, and when I say consulting companies, does anyone know what are some of the big consulting firms out there? Management consulting. Does anyone know what they're called? What are some of the big ones? No? Okay, McKinsey, Boston Consulting Group, Deloitte. These companies, these are companies that have management consulting or like technology consulting, but really McKinsey, Bain, I guess the big three for management consulting are McKinsey, Bain, and BCG as it's called, but that stands for Boston Consulting Group. So these companies have people that work for them that go and advise corporations, usually large businesses, on how they can improve their operations. And so a lot of what they do, yes, it's true, is you know put together PowerPoint presentations, frame corporate decision making in certain ways to like make it more understandable. But one of the big value adds that they have is that since they work with so many companies, they have lots of benchmark data. Okay, so a lot of times a business does not have ready access to their competitors' financial information, more than just the high end, right? Or like the publicly disclosed. So what the management consulting companies do is that they have data on competitors, and though they won't explicitly say that this competitor does this, a company can hire them and get some sense of how they stack up against competitors. And that data is not, AI doesn't know that data either because it's not really publicly available. Okay, so this is a big niche that these management consulting firms fill, is the ability for companies to benchmark themselves. Okay. Um, but yeah, this is very important. This is, this benchmarking of your company against in industry is like a very important thing to see how you're doing as a business. Okay. Any questions on this? Pretty straightforward. I think maybe seeing it in a framework is more, this is kind of what management consultants do. They'll take something that kind of everyone knows about, but put it into a very uh, uh, structured format. So this is what I'm trying to do here with why we do business analysis. Okay. Okay. All right. So let's keep going. Okay. So what are the main types of financial analysis? Well, we mentioned some of them. Horizontal. And you'll see why it's called horizontal when we actually start looking at it. Um, it basically is a way to compare a company to itself year to year. Okay, so you'll see how things are trending. This is like trend analysis, is a horizontal analysis. Vertical analysis is a way where instead of going year by year, you're going within the financial statement up and down. So that's why it's vertical. So it's going to be largely focused on this margins, um, the proportion of different accounts. Okay, so how things are how things are divided up in the income statement and balance sheet. Typically, those are the two main vertical analysis kind of financial statements that we're going to most commonly look at. So you'll have some kind of basis, and usually for the income statement, it's going to be total revenue, and for the balance sheet, it's total assets. And you're going to compare all the other accounts against that kind of basis. Okay, so like for total revenue, you'll see how much gross income you have, which is sales revenue minus cost of goods sold is gross income. So how much is that gross as a proportion to the total revenue? And you'll see like some interest expense. What portion, how much does interest expense represent as compared to total revenue? So everything in the income statement will be stacked up against total revenue. So you'll see this. I think it's easier when we kind of see it in action. But really, it's largely to see margins. Okay, margin analysis. There's also a way to combine vertical and horizontal analysis, where you do a vertical analysis for multiple years. And so that's also useful analysis. So again, when we do these two, when you see this, I think it'll become more clear. And then the third is ratio analysis. So again, we use our ratios to basically understand the business better. And there's basically these four themes, okay? The first theme is ability to pay or service debt. Okay, so uh, these are the things like debt to equity ratio, debt ratio, the coverage ratio, so the debt service coverage ratio. These are all answering the question, how able is my company to pay its debt and how levered is the balance sheet? Like basically it's a question of debt and debt and leverage, because as we know, debt can put a company out of business, right? The more debt you have, the riskier your balance sheet is, because if you're not able to pay off the debt or make the interest payments, the lenders are going to come after you, and they're going to extract their pound of flesh first, okay, before the equity holders. So if things are going badly and you cannot satisfy your debt holders, they're going to come after you, okay? They're going to come after your business. So this question of how able is your business to manage that debt load, it's a very crucial question to answer. Not only for a new lender who's thinking of lending, also for existing lenders, and also for the equity holders, right? Because the equity investors, they don't want to lose all their money. So they want to make sure that if they're investing equity in the business, it's not going to end up with them getting wiped out because the debt holders are going to take everything. Okay, so this is a very important theme. Efficiency ratios. So this is basically a question of how well the business is operating. Okay, so the ability to sell merchandise. So we had that inventory turnover ratio, right? There were two factors that we talked about in how profitable a merchandising business is. Does anyone remember what the two were? I just mentioned one, which is turnover. What was the other one? How else will a merchandising business make a profit besides just rotating its revenue as many times as it can? What is the other factor that matters? What is the goal of a merchandising business? Buy, buy low, sell high. Okay. So inventory turnover means how many times they're buying low, selling high. What else matters if you're trying to buy low and sell high? Exactly, the gross margin, right? Just how low are you buying versus how high you're selling. Just that single transaction, the spread on one transaction is important. So the spread on one transaction, which is the margin, and the inventory turnover of how many times they can repeat that process, those two things combined will determine how profitable and how successful the merchandising business is, right? So, see, this is what I'm talking about. You have to understand something about business too. Okay, the answer to that question is a basic business principles question. It's not really US GAAP is not really talking about that. So again, this is what I'm saying. You have to understand something about business models, um, to also be a good analyst. Make sense? Yeah. Okay. Um, the ability to collect receivables, because remember, if you're taking a long time to convert a receivable into cash, you're going to have to pay your employees, pay your rent somehow, some other way. And usually that's going to be from borrowing, which you have to pay interest, right? So if you're very inefficient on collecting receivables, then you're going to have to pay additional amounts and, some other borrowing, okay, to finance your business, like to manage the cash flow that your business needs to buy inventory, to pay salaries, to pay rent, to pay utilities, all that stuff. Um, Generating revenue from assets. So whatever assets you have, are you able to use those assets to generate a lot of revenue? Okay. So the ultimate, like these businesses, McKinsey, BCG, they don't have very many assets. They have some rented office space, some computer equipment, but they generate a ton of assets. That's a very efficient business in terms of generating assets. That's why they're like, they're quite profitable. Um, so some businesses require a ton of assets. Like if you're GM, you can't just create a car out of nothing. You have to have factories, machines, all this stuff to generate your revenue, right, from selling cars. So um, it's a matter of efficiency, asset efficiency. This is what it comes down to. Okay, profitability. So that's another theme. You want to know how profitable your business is. So we look at margins, return on assets, which is so just to differentiate, a lot of these efficiency ratios are about revenue. Okay, profitability is about profit. At the end of the day, that's what trickles down to the shareholder, not just the revenue, right? Because you have all your expenses. So profitability is looking at the bottom line. A lot of the efficiency ratios are talking about top line, right? So generate revenue from assets. That's a different question than generating profit from assets. Okay. So the profitability is now looking at that. At the end of the day, the bottom line, which is, the bottom line comes from this. Top line is revenue. Then you have all your expenses. And then you have the bottom line, which is net income. That's why it's called bottom line. That's where that term comes from, because it refers to profit. Okay, so this is a whole theme. Return on assets, which is your profitability determined by how much assets you have. Return on equity. So what is the equity that the investors have contributed, owners of the business, as it relates to profit? So these are all profitability ratios. And then finally, valuation. Okay, so this has to do with market price. Okay, so we talked about how the book value and the market value are two different things. Okay, um, again, for McKinsey, BCG, those consulting companies, maybe the founders had to contribute, $5,000 each when they first started, and they were just able to grow by internal kind of reinvestment of their profits. And so the contributed capital is not that much, but the businesses are worth a lot because they're able to generate a ton of revenue with that. Okay, and probably the partners have taken money out of the business too, so you can't really tell from the return on equity what a business is worth because again, it could be very asset light and it didn't need much capital. It could be that the partners or the investors have taken a lot of the capital out of the business, so the book value of equity is really low. So the market value is going to largely for many businesses be determined by profitability, and you're going to have to do some other kind of analysis to figure out what the value is. Okay, so I think we only talked about a few of these. The PE ratio, which is the price to earnings, meaning the market price to earnings. But anyways, yeah. So these are related to. We're now adding the extra layer of what is the market price of the business, the market value of the equity, which is different again than the accounting value. Okay. So those are the main ratios, and we'll get practice calculating them, and using the financial statements to do that, because all the information is, except for this one. So for valuation, you have to look to some market, right? And usually it's a stock market for publicly traded companies. You can get the market value of Apple, the stock of Apple, by looking at the market price. You couldn't look at the balance sheet because that's just going to tell you the accounting book value. Okay. Um, okay. And I think this one is conceptually a little complicated. We'll try to revisit it again. Okay. Um, okay. So what are the sources of data for all this? Um, every public company, they have special pages for their investors where they have press releases, they have all the financial statements, all the quarterly statements, the annual statements. They're going to have it all compiled in one place. So if you ever wanted to research a company, you can just into Google put the company's name, investor relations. Okay, and that will take you usually straight to the site. It'll be the first link. And on that page, you'll see the annual reports, quarterly reports, press releases, any presentations that the company has put out. The each quarter they also give a conference call where the executives of the business give like an open kind of presentation of the quarterly results, and there's Q&A, so you can listen to that. They usually have an audio recording of that, which is pretty informative, because you can hear the questions that professional analysts are asking management, and hear how they respond. So all that is going to be on the investor relation website. Okay. Um, the government also has a repository where the company has to kind of post all their required filings are on this site called Edgar. Okay, so uh, you can find a lot of information on Edgar, like what managers of the company are either buying or selling stock in the company, right? So if you saw the CEO was selling a lot of stock, that is informative. Why is that informative? Why would you be interested to know whether the CFO or the CEO or some upper management is selling a lot of shares or buying a lot of shares? What information is captured in that? Yeah,
Confidence in the company.
exactly. Okay. If they're buying a ton of stock, they know more about the company than you. Okay. No matter how good of a financial analyst you are, the CEO, the CFO, the managers of the company that have access to all the financial information, all the deals that they're doing, they're going to know more than you. And so if they're buying a ton of stock, that's usually a sign that something good is happening for the business. If they're selling a lot of shares, it could mean a number of things. Maybe they just they need cash to buy their house in the Hamptons or whatever. It could also mean that they're selling because they are not confident in the company. Okay, so but that information is going to be posted in Edgar. If any insider buys or sells more than a certain number of shares, they have to publicly disclose that. Okay, so you can find that information in Edgar. Um, there's also these third-party data providers. Some of them are very expensive. Capital IQ, FactSet, these are like what professional investment analysts will use. They're really good though. They compile all the financial statements in one place, clickable. They're extremely useful and time-saving devices. Uh, I think I sent this podcast out of this guy Steven Schwartzman. He's the founder of Blackstone, which is like a large private equity firm. He was saying when he first started out in this investment management business, he would have to read newspapers and take paper documents and compile everything together. And that had its benefit because he knew all the numbers. But this technology, having stuff online and like in a computerized format, it is 100 times faster than it used to be. Okay. And now that's kind of what's happening with AI. Some of the analysis that people are doing that takes some time, now that's way faster. Okay. So, but this is a very, very useful tool if you're doing investment analysis. These Capital IQ, FactSet, um, Bloomberg Terminal, which is the most terrible user interface you'd ever imagine. But it's such an entrenched, like, uh, it has a very entrenched role in the financial services sector, even though it kind of sucks to like use. It's still like one of the big main ones because people just know how to use it. Um, if you work in that field, uh, Yahoo, Google, Finance, Webull, like now there's a lot of free stuff that actually have pretty good tools too. Um, so there's a lot of information there, and then just like other stuff. There's a lot of stuff online that's compiling financial information. Okay, um, and then there's proprietary data. So this is like consultants or industry publications. These are usually also very expensive. Okay, you have to have a subscription, and it's very useful information. Like the pricing of certain commodities. Like if you wanted to know the price of like I don't know, some rare earth metals quarter to quarter. That's not very, it's not available to the general public, but it's going to be in some industry publication. There's someone tracking it and then selling that data. Okay. Um, okay. And then here's some useful codes. A 10K, you'll hear this term a lot, is a company's annual report. And these are all basically tied to this Edgar website. Okay, so all this coding is how the government has called all these different types of documents. So a 10K is an annual report, a 10Q is a quarterly report, and 8K is kind of like a press release. If there's any major event, the business has to disclose it and put it on Edgar as a 8K. So I'll show you Edgar in a second, but if you just search the 8Ks for some business, it will show like all the major events that have taken place. Um, Form 4, this is what I talked about, where if there's a major buying or selling of shares by any insider, so this is officers, directors, or any shareholder that's greater than 10%, they have to kind of disclose any change in their ownership. Um, this is another one that you can get a lot of information. A 13D is when an activist investor first takes a stake in a company and it has more than 5%. So a lot of private equity investors, um, if they're gonna try to shake up a company and like redo the management and stuff, they're gonna first disclose it because they're gonna start buying shares in the public markets. Okay, and once they reach 5%, they have to first say, "Hey, we reached this threshold of 5%." So you, if you're a savvy investor, could search Edgar for 13Ds and see what private equity buyers or what private investors have now a large stake in a company. And if you know anything about them and you're like, oh, these guys are good, they like do good restructuring of businesses, you could pile on. You just buy into that company too, and you wait for them to do the hard work of turning the business around. Okay. Um, and then S1, this is when a company first goes public. This is what we call it an IPO filing, initial public offering. So this is when a company is transitioning from private to public. And so like Uber, when they first went public, no one knew very much about their financial statements. What was their revenue? What were their expenses? And so when they first were going to go public, that S1 filing was really important because that's when they first kind of they opened up their books essentially to the public. Okay, so a lot of companies like they're saying OpenAI is not going to IPO because their numbers are not that good. Okay, because if they're going to file, they'll have to file an S1 and present their financial statements. Okay, so people are saying that they didn't hit their revenue numbers, their user numbers, all that stuff, and so they're going to postpone their IPO because right now it's opaque. You don't know exactly how much revenue OpenAI is generating. You can guess, you can use some proxies, but you don't actually know, like you do with Google or some other public company that has to file every quarter. Okay, so there's a downside to private companies to IPO in that they have to now disclose their financials. Okay. Okay, so let's look at some stuff. I think this is Merck. Merck is a pharmaceutical company. Um, let's look at their uh, investor relations website. Okay, so this is what it looks like. They have their stock price. You can argue this is their product. their most important product, which is their stock, and they want the scientists maybe not so much, but the managers of the business, they're really focused on this. This is the important number that they're judged by for many companies is just the price of the stock. Okay, so they have news. You can see um, they have some press releases. They have this tab for events and presentations. So again, this is like the webcast. So if you wanted to uh, listen to the CEO and the CFO and their chief research person, uh, they're all speakers in this conference call, and you can hear what they have to say. Usually, they're reading like like prepared stuff, but the Q&A, there's a lot of information where there's like professional analysts who are following these companies who have really detailed questions. So they're asking, and the executives will answer, and that is like not scripted. They don't know the questions ahead of time. Um, so you can see their earnings call. They have some presentations here, and so they're Form 10Q. So they're going to have their most recent filing. So if we click on this, you can see this is Form 10Q, and it's their quarterly report. Okay, and it's going to have financial statements. So you can see here are their financial statements, and of course they'll have all this other stuff. So if we look at the table of contents, they have their financial statements. They have like just a discussion where they're writing out kind of in plain English what's going on with the business. They'll have some disclosures, and then just some other stuff. Okay, the annual report is longer. They have many more disclosures and like other stuff they got to put in the annual. The quarterly is a more abbreviated report. Okay. Um, okay. So, any questions on this on investor relation websites and what you can find there? Okay. So Edgar, this is you can see it's a government website, which means it's going to be like not the most best. It's not going to be the best UI, you know. But let's see. Let's do. So I just put in Tesla's ticker, TSLA. You can see it came up here. Okay, so you can see there's selected files. The 8K, which is again the kind of press release, like what important things have happened. Earnings release. You can see they have their 10K and their 10Qs. So there's a separate link for that. Um, you can just click on this to view all of them, and it'll just give you a list of all the stuff that they filed by the filing date. Um, so yeah, there is some embedded information in here. Okay, now one of the things with AI that they're saying is going to be great is the AI will just immediately go into here and like read whatever is posted right away and can give you an update and summary. Okay, because as there some of these things are like hundreds of pages long. The annual reports, quarterly reports. So if you can have something that can read it in 10 seconds and then give you a summary and like is kind of trained to know what to look for, then it can save you a lot of time and you can act fast. Because a lot of it is acting quicker than someone else. That's at least in the short term kind of hedge fund world or short term trading. Acting fast is a big advantage. For long term investors, maybe not so much. It's better to spend the time to really read these to understand what's going on. Okay. Okay, so yeah, if you're interested in financial like investing, I would recommend spend some time with Edgar, go through the filings, see what they're like, um, download some of them and put them into AI and have the AI help you understand what's going on. I think it's the AI is great to help you learn things. If you're just uncritical, just copying and pasting it, I think that's a problem. But as a learning tool, I don't think there's a better one. It's better than me. It's available 24/7, I think I'm pretty good, but the availability is just not there. And the depth of knowledge, it does know more than me. Maybe it's overconfident what it knows. It thinks it knows things that aren't true, but it does know a lot. So I would say try to use it to your advantage to learn yourself, but be skeptical too. Be, push back on it because it's not always right. And as soon as you push back, it's like, oh, you're right, And so I'm sure you guys have all seen that happen. Okay. Okay. So, um, why don't we take just a couple minutes? I've been talking a lot, so why don't we just take till 1:40? Just take a little break. All right. So let's get back to this. So I have a set of financial data here. And so we'll talk about the different types of analyses. We had vertical and horizontal. So this is the revenue. I don't know. I think this is Exxon. I think I just took the revenue. And so what I'm gonna demonstrate here is this horizontal analysis. Okay, you can see here the years are arranged horizontally, and I'd have expenses here if I did the full thing, net income. Okay, whatever. You have each year's information kind of arranged in columns. Okay, but let's say we just cared about revenue. So what you would do in a trend analysis is this is the biggest trick. Okay, the biggest decision you're going to make is picking a base year. Okay, so let's just use the oldest year, 2018, as the base year. So what you're going to do, and it's very easy to do in Excel. You can do it in one formula. Okay, you basically want to take the cell above divided by the base year. And in this case, the cell above is the base year, but I want to fix the denominator, right? So I'm just going to put F4 here. Okay. So now this formula is going to take whatever cell is above divided by J5, which is this 290,021, which is a fixed. Okay. So does everyone understand this? The numerator moves around. The denominator is a fixed cell. Okay. And right now it's just giving me 1, but let's just move this out a little bit to make it a proper kind of ratio. So now I'll just copy this cell. If I paste it here, you can see that it's taking the number above divided by this fixed cell here. Is everyone good with this formula? So now when I apply it rightwards, it's going to do this trend analysis. So if I just go like this, and I do Control R, I have my trend analysis. Okay, so you can see here that the revenue dropped a lot. I think this is Exxon. Why did the revenue for ExxonMobil drop to 63% of what it was in 2018? What was going on in the world? COVID, right? People stopped driving. People stopped, whatever. All the stuff that requires oil and gas was drastically cut down. Okay. And then you see that it eventually picked back up, peaked in 2043, and now it's like, declined again. It's probably up now. If we looked at ExxonMobil in 2026, what is it going to be? It's going to be higher than this, right? Why? What's happened since January or December 2025? Yeah, Strait of Hormuz, exactly. I think oil prices doubled since then, right? I think it was around $70, $80. Now it's like $140 a barrel. Okay, so the revenue is gonna definitely increase because we're still consuming. Unless you would think that higher prices for oil may cause demand to go down, which definitely happened to some extent. But usually for oil and gas companies, when the price goes up, their revenues go up too, and they make a lot more profit, at least in the short term. Okay, so why I said that this is a tricky kind of thing is like in this horizontal analysis, we see that 2025, we're ending at a 14% increase from the base year. Does everyone agree with that? 1.14 means that the base year plus 14%. Okay. Now let's see what happens if I wanted to be a sneaky analyst at ExxonMobil to convince people our business is doing great, I could just do one simple thing to make that trend analysis look way better. What could I do? Yeah, exactly. Okay. If I change the base year to 2020, okay, so now I can say, oh, so in this case, I could say revenues are up 14% from 2018. Okay. Using the exact same numbers, but just changing the base year, I can now say revenues are up 83% from 2020. Okay. So this is a trick that is used a lot by politicians, by financial managers. Okay. If you look at a mutual fund, it'll say our 14-year return is this. Why do they pick 14 years? Why not 15? Why not 10? It's likely because some base year kind of thing that they're doing. Okay. So the trick of base year as a comparison is gameable. Okay, you need to be aware of this. This is like, don't get fooled by, all the people trying to play games with numbers and statistics and all this. Okay, this is a very common sales trick, essentially. Okay, so does everyone understand this? How base year is going to affect what your analysis kind of looks like, even though the numbers are the same? That makes sense? Yeah. Okay, but this type of analysis is a horizontal analysis because as you can see, the analysis is going horizontally from left to right, right to left. Okay? Okay, so now we can apply this kind of to this is our income statement. So we can do a couple of things. We could do a horizontal analysis using the oldest year as a base year. Okay, so you can see that we have some volatility in the revenue here. Okay, it's going up and down. It's fluctuating, and this year it went up a little bit, and then this year it's down from the base year. Okay, so you could do this for all of different accounts. Okay, so you can see that total revenues is almost the same as the base year. In this case, it's a little above. And you could just, again, do this type of analysis for every single account here and get some information. There might be some, oops, let's see what this is. Oh, okay, sorry. What I would need to do here is change this. Okay, what's going on here? Okay, so you can see here that we can see that our revenue did go down, but our total costs are unchanged. And so if we look at our income before income tax, it is significantly lower. And then if we did this for net income, we can see that the lower revenue is translating into significantly lower profit, okay, over time. So this horizontal analysis you don't have to just do for revenue. You can do it for any of the accounts that you cared about. Okay, so um, we can also do something that is maybe more informative. Is we first will do uh, a vertical analysis. Okay, so what is a vertical analysis? Um, Instead of going from years, we now just will take 1 year and do an analysis going up and down. And so what you will usually do is use your total revenue as the basis. Okay, so for example, this divided by, and I'm going to fix this cell. And I'm going to make these percentages. I think that will make it. And then I'll do this. So you can see here, everything is now a function of total revenue. Okay, so, and this is useful because, and for this top part, you can see what the percentage is between all the sources of revenue. You can see what the breakdown is. This this line item is 97%, 1.52, etc., to get to the total revenue. And then you can see how their expense structure breaks down. You can see that this is, as a percentage of the total revenue, the largest expense, which is the actual purchase of crude oil. Okay. And you can see that some of these are minor, and you can of course see it by the actual number, but this is giving you a better sense of the proportionality between the income statement. Okay. And also very importantly, it's giving you margins. Okay. So the income before income tax, which is, you can consider this, um, actually, yeah, they give it their presentation is a little bit non-standard because they're first putting interest expense and then um, not giving a subtotal before that, because really this would be operating income, which is a standard kind of thing where it's basically your profit before interest, before tax, before any of the other miscellaneous stuff. It's just from the operations of the business. Okay, they're not giving that to you, but usually you would want that margin. Okay, that's an important margin because that is the margin without considering what country you're domiciled in, because that's going to affect your tax rate. It's not considering how you finance your business because that's going to affect interest expense. But they're not doing that, so it's okay. But this is, this income before income tax is an important margin to know too. Okay, this is like, it's almost like operating income because you can see interest expense is very small. So they either have very low interest debt or not that much debt. And then you can see, of course, this is their net income margin. Okay, so this is after taxes, after all the duties, all the stuff they pay. This is their net income, and of course, they have some minority owners. Um, and which is basically like minority shareholders, like of subsidiaries they own. So ExxonMobil owns probably thousands of other entities, but they combined all those entities into one combined financial statement, even though they may own like 80% of some other subsidiary. That 20% owner actually should get 20% of the net income from that subsidiary. So that's what this kind of minority interest is. It's a kind of a technical thing. You'll probably cover it in intermediate or advanced accounting. But basically, this is the net income for the shareholders of ExxonMobil. Okay, and you can see it's 8.7% of this total revenue. Okay, so for every $100 of revenue, they only have $8.50 of profit. Okay, everything else is going to taxes or expenses or whatever. Yeah, Margarita.
This approach totally ignores that some of these items gonna be subtracted, some gonna be added, so it just totally ignored.
It doesn't, because look, to calculate net income before income tax, it's basically this minus this equals this. So in the numbers, that's where the calculation happens.
But when you calculate percentages, the percentages don't have minus or plus.
Yeah, but I didn't need to because I'm just like this 41,000 has a revenues minus expenses, right? I just want to know what the margin is. So for every dollar of revenue, what is the margin of profit, right? So this percentage calculation is not trying to recreate the the income statement. It's just showing the proportionality.
Mhm.
So I just want to know that this profit number, 41,000, let me contextualize that based on the total revenue. What is the margin I'm making? Make sense?
Yeah.
Okay. Okay. So if I did this for all the years, let's see. I could then look at how my margins are changing too. Okay, so let's see, because it's hard to tell whether my margins are going up or down just based on the numbers, right? That's why this is like a useful analysis. So let's see if our profitability, we know our number of dollars has gone down. We're making less money, but has our margin gone down? Let's see. So yes, you can see margins have also gone down. And then let's just do it for this last year. So yes, the trend is not in the good direction for ExxonMobil. Okay, the revenues are fluctuating. It went up the second year, but then down the third year. The margins are just declining every year. Okay, so maybe all those activists, like protesting outside ExxonMobil, are having an effect here. Okay, um, whatever the reason, there's probably some structural reason. We'd have to know. Again, this is when your industry understanding is going to play into this. Because I'm sure if you ask an oil and gas analyst why this is, we'll discern whether it's a structural thing in the oil and gas market or whether it's ExxonMobil as a company doing some dumb things. Okay, we can't really tell that just from this. We have to understand more about the context of the industry, ExxonMobil's business in more detail, what investments they've been making, where they're spending money, how do they stack up in their peers? Like, is there SG&A? Is this 3.35%? Is that too high or too low? How does that stack up against Chevron? Maybe Chevron is only 1.5% SG&A. So we don't know, because if you change this, if you lower this margin by like 1 or 2%, that's gonna significantly boost this. Okay, so we don't know where the mistake is for ExxonMobil. Maybe the Chevron's margins have shrunk even more because the oil and gas industry is going through some pains. Okay, so this is why financial statement analysis needs to be paired with your general business knowledge. It's not enough just to understand what's going on here. There is a larger context that this business is operating in. Make sense? Yes? Okay. Okay, so any questions on, like, I think doing the technical, like making the analysis is pretty easy in Excel. If you just know basically how to set up this formula, which is again, the cell divided by the fixed basis. And you have to put those dollar signs. Okay, because look, the next one is the next cell down divided by that same B7. Oops. Same thing. Okay, and this is, of course, is that divided by that. And so if you just get this one formula right and just apply it to all the lines, you're kind of done with the analysis. Okay, so in MyLab, it will give you the financial statements. You go open up that little window, you say copy to clipboard or something, you paste it into Excel, and then you just do this formula and you're done. You just like copy and paste it to get the answer. Okay. This is again why I've been trying to encourage you all to use Excel. It makes this type of analysis like people used to have to do this by hand, like every number with a calculator. And they thought when spreadsheets first came out, they thought accountants are going to disappear too. But if anything, there's more accountants now, than there were because there's just more work. There's more analysis you can do. So I think AI is going to be like that too. There'll just be more. There'll be things that people didn't have time to look at. Now you're going to have time to do it. Okay. Okay. So I think what else do we have to say about this? Okay, the balance sheet, you can do the same thing. Okay. Um, Again, the basis on the balance sheet is going to be total assets. So I just take this divided by balance sheet, or sorry, total assets, make this a percent. And then this divided by total assets. Okay, so look, this is total liabilities and equity, 100%. Total assets, 100%. Why? Our accounting equation, assets equals liabilities plus equity. So the basis is assets, but it's also the same as liabilities plus equity. Okay. And now you can see how everything is divided up. You can see of their assets, property, plant, and equipment is by far the largest portion of their assets, and that's what you'd expect because ExxonMobil owns uh, a bunch of property. Okay, they own all these oil fields all over the world. They're like a huge owner of assets. Okay, of these property assets. They also have refineries and like all the stuff, tankers, whatever. So it's quite obvious that they're going to be very heavily in PP&E. Okay, but you can also see, other inventories, notes receivable, accounts receivable. So, it gives you a sense of how their balance sheet is kind of broken out. What are the important assets to the business? And then, of course, one big piece of information here is this and this, right? You can see how they're financed. Lots of, it's kind of like a 60-40 split. Um, Interestingly, the reason why maybe they didn't have a lot of interest expense, most of this liability is current. Okay, these are probably trade payables. Okay, so they're not interest bearing. Okay, so though they have a lot of liabilities, the amount of long-term debt they have, this is the stuff that, like a bond that pays interest. It's like only 7.63% of of the size of the balance sheet. Okay, so they're using their vendors a lot. That's what this is. Okay, their vendors are giving them interest-free loans, essentially. Okay, and then I guess deferred income tax. So the American taxpayer, is also giving them liabilities. They owe the IRS a bunch of money through. They probably have some special tax advantages that they're taking advantage of, where they can defer tax. Okay, so and this is like an interest-free loan from the government. Like any tax that you owe, but you're allowed to pay in the future, you're essentially like that's like a loan, right? The government could have that money now, but they're letting you pay it later. So that's essentially like an interest-free loan. Okay. So, and of course, you could do this for the previous year and you can see how everything is changing. Okay. So this is like uh, I guess let's just do it just to see what has changed. Okay. And I'll just turn all these into percentages to make it more readable. Okay, so you can see that they've grown a little bit in PP&E. So they've probably they have net acquired more assets. You can see their current assets have dropped. So, if this is your company that you really know well, this information will be useful. You'll be able to, you'll probably come up with a bunch of questions of like, okay, well, what were the new assets they bought, And you'll read into the notes and see what they were doing in the year or the discussion. Okay. So, this analysis should also lead to a lot of questions of like, why is this happening? And that's going to force you to learn something about the business. Okay. So that's why this type of analysis is also useful. It's not gonna always answer questions. It's gonna usually lead to more inquiry. Okay, and then the final thing before we, I think, talk about the ratios briefly, because I think it's better that we spend time just calculating the ratios. But let's just finish this analysis stuff off. This is a kind of vertical analysis where we're having two different companies. So you can see I have Chevron and I have Exxon together. Okay, so now this is maybe going to be even more informative. Instead of comparing Exxon to itself, okay, I'm going to do a vertical analysis on each of these competitors. And we can compare and see how the margins stack up. You can see dollar-wise that Exxon is much larger than Chevron. They have much more revenue. But now we can compare margins. Okay, we can see that Chevron has a higher cost structure. They have more total costs, 89% versus 87%. You can see that their margins are lower. Okay, so though we saw a trend with ExxonMobil where their margins were going lower, we see maybe they're actually pretty good. Like maybe it's just an industry thing where oil and gas, for whatever structural reasons, the margins are compressing. Okay, there's more supply. There's some structural thing that's happening in these years that is causing the margins for the whole industry to shrink. Okay, and you can see here just on the net income bottom line, ExxonMobil is stronger, far stronger than Chevron. Okay, so hopefully now you can see it's called a common size income statement, meaning that we've converted all these different dollar amounts. We've converted it rather into this margin analysis, which allows us to compare much more easily. Does it make sense? Yes? Yeah? Okay. Okay. So let's just finish this up, and the rest of the class and like on Wednesday, we're just gonna do practice problems. Okay, so I'm gonna try to finish the lecture, and then we can just practice doing this with some more involved practice problems. Okay, so I'm not gonna go through each formula individually. Okay, I think it's better we just talk about the themes again to make sure that you're clear, and then we just move on to practice problems. So again, this first theme is ability to pay current liabilities. Uh, the main theme, I guess, was to pay off liabilities in general, but there is a number of them that were just related to current liabilities that we talked about. So if you remember, the most lenient was this one, where we took a ratio of all current assets to current liabilities. That was the current ratio. This next one was a little more stringent because we got rid of the less liquid current assets. Okay, because for example, inventory, it may take a long time for that inventory to turn into cash. So if we needed cash right away to pay off our current liabilities, inventory is maybe overstating how safe we are. So we remove inventory from the ratio. So we see it's only cash, short-term investments, and receivables. Okay, there's no inventory, there's no other current assets. So this was going to be so this is a subset of current assets, right? So this is the asset test ratio by definition will be equal to or lower than the current ratio. Okay, it's only equal if we had like no inventory or no other current assets, but it will be lower because it's more stringent. It's taking only the most liquid part of our current assets. And then even more stringent than that is just taking cash. Okay, so then we get rid of short-term investments, we get rid of receivables, and we just look at how much cash do we have on hand to pay off our current liabilities. Okay, and then working capital, just the definition is current assets minus current liabilities. Okay, so there's a lot of detail of working capital, why it's important. I think it's like a little more advanced. So I think just for now, just know the definition of that. Okay. Um, ability to sell merchandise inventory and collect receivables. So inventory turnover, these two are related. They're just kind of a function of one another. Um, basically seeing how long it takes to sell inventory on average. Gross profit percentage, which has to do with that buy low, sell high for a merchandiser. Um, accounts receivable turnover ratio. This has to do with how quickly we're able to uh, collect our receivables. And then day sales, these two are also kind of functions of one another. Okay. Ability to pay off long-term debt. This is another theme related to uh, leverage. So the debt ratio, which was total liabilities divided by total assets, it's actually related to this debt to equity because remember, this is L over A, this is L over E, but we know that L, E, and A are all related because A equals L plus E. So, they're all related. Uh, there are different ways of showing how much leverage there is on the balance sheet. It's not like they're saying two separate things. It's just a different, it's a different formula, but they're related to each other. There's one-to-one correlation. A change in the debt ratio will change the current ratio or the debt to equity. Okay, because they all move in lockstep with each other. Um, and then times interest earned. This is the debt coverage ratio. We saw how much earnings there are that support the interest payment. Okay, so this is there's many themes of this coverage ratio. This is like a very basic one. Because again, interest expense does not include maturities, right? A bond maturity is going to have this big balloon payment that you got to come up with. Okay, so this interest earned ratio is is a very simple uh, ratio that doesn't tell the full picture, but it could be somewhat useful. Okay, it's a starting point. Yeah, I guess you can say if you're not even good on this, you're cooked. Like the details don't matter. Okay, so this is like the minimum first step thing to make sure you can at least service the interest. Okay, profitability, profit margin ratio, return on assets. Again, all the formulas are here for you. Okay, so you can just refer to the slides. But I guess the important thing to remember that these are all trying to answer this question about profitability, bottom line, how much return profit is the business generating for the owners. And then valuation. So price to earnings ratio, again, this is going to be related to the market price per share, the dividend yield. Now, we had that, we had for bonds, that discounting of cash flows to get the bond price. You could kind of do that if you knew how much dividend income you're getting per quarter or per year or whatever, and you can do a similar analysis. So dividend yield is a potentially useful measure as a way of valuing the stock. Okay, but I guess for now, again, that's like a more advanced topic of business valuation is like a whole other topic. But I think just know the formula for dividend yield. Um, it's basically a way to see uh, if you're paying $10 for a share, how much income will you get from the dividend? Okay, so you can see annual dividend per share divided by the market price. It's going to get you like a yield, similar to investing in a bond. And then dividend payout, um, dividends paid divided by net income. If this ratio is 1, what does that mean? Yeah, Mohammed. Yes, it means that however much net income, however much profit the business generates, it's not retaining any of it. It's paying all of it out to its shareholders. Can this be greater than 1?
Only if it's taken away from the company's earlier earnings.
Or it can borrow money. You can borrow and pay a dividend. Some businesses, believe it or not, are crazy enough to do this. If this ratio is greater than 1, it is unsustainable. At some point, the business will go out of business because you cannot pay out more profit than you're generating. Now, some businesses are like, well, we had a bad quarter, a bad year, so we'll pay out more than we earned this quarter. But structurally, it cannot be for a long period of time greater than 1 because you cannot pay out to your shareholders more than you're earning. Berkshire Hathaway, Warren Buffett's company, the payout ratio is 0. That company does not pay a dividend at all. It chooses to retain all profits. It's been extremely profitable over its like 40, 50-year history, but it's chosen to reinvest all of its earnings back into the business. And that's worked out for the shareholders because Warren Buffett is a far savvier investor than the common person. That cash coming into your bank account, it probably would have been spent on something. But instead, Warren Buffett took that money, invested in some new business, some other investment, and he compounded it for 50 years. And if you had put $1,000 into it back then, you'd be a multimillionaire. Okay, so a dividend payout is not necessarily good if you have smart people running a business. You actually want them to keep the earnings in the business and reinvest it. Okay, and then finally, let's just end with this, and then we'll start the practice problem. So, red flags. Okay, there may be, and this is just a short list. This is just some examples. Okay, and you'll, based on your industry, based on the company you're looking at, there's many of these. There's an infinite number of these. Okay, um, but the common ones, negative trend in revenue. Okay, so if you see the revenues declining in your business, that's like a red flag. You got to be on the lookout for that because at some point, if you have leverage, it's gonna cause you big problems. If you're not downsizing your expenses at the same rate that your revenue is declining, um, that's gonna lead to problems. So that's why companies lay people off and stuff because oftentimes their revenues are declining, and they gotta just right size the business so that they're still profitable. If merchandise inventory is building up, so if you're a merchandising business, you see the inventory is getting higher and higher every quarter, that means they're not selling stuff. Okay, that's a problem. Okay, if the revenues are growing in line with the inventory buildup, that just means your business could be growing. But if your revenues are declining and your inventory is going up, you're probably in some trouble. Receivables also growing as a proportion of revenue or as a proportion on the balance sheet also means maybe you're not able to collect from your customers. You've extended credit to people who are not going to pay you. Okay. So all these things are like things that you need to find out more about. Earnings problems. So if you have losses, if margins are continually declining, these are all things that you need to look out for. Um, Cash flow. Okay. So you look at the cash flow from operations. This is from what we just covered last chapter. If you see that the cash flows are declining, um, that's also something to look out for. And then too much debt relative to the size of the balance sheet. So you'll see that in the debt to equity ratio, the coverage ratios, um, all the ratios related to current liability coverage. So you have to be paying attention to that. Okay, so these are just some. This is, at the end of the semester, I'm going to recommend some videos and some books to read. One of the books I will recommend is called Financial Shenanigans. And I think it's the best accounting book out there because all it does, it's a 300 page book on all the common tricks that companies play in the financial statements. Okay, and it's good for you at your level because you now understand something, hopefully, about financial statements and what these accounts are. So when you read that book, you'll now remember those stories of how these companies are manipulating financial statements. Okay, and I think that's actually the best way to learn financial accounting is to see when things go wrong. Okay, all right, so um, let's now transition to the in-class work. There's two problems that are pretty long. So, they'll definitely till the end of today, and we'll just keep working on it on Wednesday. Okay, so just open up the spreadsheet and we'll start doing this.